I'm Caitlin at Security National Mortgage, and we're here today with Alicia, our rep from Enact. She represents them, and they offer PMI, or private mortgage insurance. And so we're talking today about what that is, how to avoid it, and maybe why you don't want to avoid it. Alicia, tell me, what is PMI?
Private mortgage insurance gives the potential homeowner the ability to get a mortgage with less than 20% down. Basically, it insures the loan and covers the lender, but it is paid on the borrower's behalf.
That's important to know. I think some people think that it insures them, the borrower, but it really insures the lender and allows you to put less money down in the event that you default. They've got that equity established. Okay.
Yes, correct.
I think a lot of people feel like they have to put 20% down and avoid the PMI, but that's maybe not true, right? PMI is maybe a good option.
I agree with you. Giving your customer the ability to put less than 20% down leaves a lot of money in their pocket. You never know if you're gonna have home expenses, buy new furniture. This is a great option, and it also does not stay on your mortgage through the life of the loan. So it will fall off at a certain point, and we could cover that.
That's a really good point. But the mortgage insurance, you can request that it fall off once you hit that 80% loan to value mark after you've been making payments.
Correct. So your mortgage insurance will automatically fall off when your loan to value reaches 78% of that original purchase price. The mortgage servicer is required to remove it at that point. If the homeowner knows that their loan to value is at 80%, like you said, they can request removal with their mortgage servicer, and then it will fall off then.
Perfect. You should really check in with your loan officer that did your original loan and find out if you're getting close on those numbers, if you're not going to refinance. That's really cool. And it falls off, which is super important because most of the government mortgage insurance don't. They are on there for the life of the loan.
Life of the loan. With government, you have to refinance to remove that mortgage insurance.
That's important. I think a lot of people think that it's really expensive.
I think that's a myth. Most mortgage insurance premiums are fairly low. Of course, it depends the loan scenarios, your credit score, debt to income, and the loan to value. But for the most part, in most scenarios, monthly mortgage insurance is very low. And then there are multiple other options when it comes to mortgage insurance, like singles and splits. And I would advise that you check with your mortgage loan originator to cover those options.
We've got lots more options with private mortgage insurance than we do government mortgage insurance. The government mortgage insurance, the factors are kind of what they are for the scenario. Private mortgage insurance, I always tell people, is tiered based on risk. So the higher your credit score, the lower your debt to income ratio, you'll get some price breaks for being better qualified. I had a client just last week, he really was focused on putting 20% down, but he is going a little higher on the purchase price than what he planned, and he was scraping together that 20% plus closing costs. And I quoted him his mortgage insurance. It's under $30 a month. He's having to come in with $40,000 less and spending $30 a month. It was a no-brainer, and he was so against PMI.
But then when he saw the $30 a month, he was probably like, wow, it's not that bad.
Correct.
Right?
He was really surprised by how inexpensive it was. A lot of people think that you have to pay PMI monthly, but that's not true, right?
That's not true. There are multiple different MI premium options. One is a single premium, which you can either pay at closing or you can finance it into your loan in some scenarios. This completely removes the monthly mortgage insurance payment. That is one way if you're payment sensitive, best when you're helping your customers find the best payment options and loan programs. You might look at a single, and that could save them hundreds of dollars on their total monthly payment, and then they'll not have that monthly.
So right now we're getting a lot of seller concessions, and we could use the sellers correct to pay for that one-time cost at closing for the mortgage insurance, and then the clients could put less money down,
correct,
and then not have it as part of their payment. Well, that sounds like the best case scenario. I can think of one scenario that we did even a split premium, which is less popular. They couldn't afford the whole thing up front, but our debt to income ratio was too high for the monthly. And so I actually was able to split it.
Yep.
And we saved that loan that someone else turned down because they weren't getting creative with that mortgage insurance.
That's right. If you have excess seller concessions or you have room to finance a split into the loan, basically a split option is the equivalent of buying down your interest rate, right? So you're paying a lump sum up front, either on the bottom line or financed, and you're buying down the monthly mortgage insurance premium. It helps with debt to income. It could avoid you having to go FHA or government products.
That's a good way to look at it. It's almost like a discount fee in terms of your mortgage insurance paying at one time.
Yep.
To save you per month. I like that scenario. PMI seems that it kind of has a stigma and should be avoided, but the truth is you really can spend $100 a month and save tens of thousands in the bank.
That's right. It allows the borrower and the homeowner to put less than 20% down. You could think of it as paying hundreds to save tens of thousands in the long run.
And upfront costs.
Upfront costs.
Totally. You hit on a scenario about someone buying a new home, putting down the minimum payment, knowing that they were going to sell their vacating residence, and then immediately they could apply some of that equity to
Yes.
that and wipe out that mortgage insurance.
Yes, so we're seeing a lot of those scenarios where the homeowner is going to be making a principal reduction shortly after closing. And in that case, the MI can be canceled immediately once that is done. Of course, the servicer will have to put the request in with the mortgage insurance company, but if that loan to value is at 80% or lower, the MI will fall off.
Take it off.
Yes.
Cool. Very good to know. I talked to a lot of people that are focused on saving their 20% down. And one thing that they're missing out on is while they're saving that big down payment for their first time home purchase, they are missing out on big appreciation numbers. On it, for an example, if you're going to purchase a $500,000 home, 20% is $100,000. If you're saving $500 a month towards that down payment, it's going to take you years to be able to save that 20% down. However, you can put a way lesser amount down and get in on the appreciation. In Salt Lake alone, in the last 5 years, our home prices have rose 84.6%, and statewide, we're up 65% in 5 years. If you're waiting those 5 years to save for your down payment, you have missed out on big amounts of growth. Now, I know the last 5 years are kind of an anomaly, but since 1967 to 2024, the entire country has seen an average of 4.27% in appreciation, which on a $500,000 home is over $20,000 per year. If you aren't saving $20,000 every year, buy a house. Also, every month that you make your mortgage payment, you are putting money back into your pocket by paying down that loan. Not only do you own an appreciating asset, you owe less on it every month. And the first year of mortgage payments, you are going to pay down that loan by over $5,000. Not only did your house appreciated $20,000, you paid it down $5,000. If you aren't able to save $2,000 a month in your pocket, buy a house. There's a lot of different mortgage insurance companies to choose from, and for us, we usually price out a couple and choose the cheapest one. But Enact, who you represent, they have something really cool called Home Sweet Home. Can you tell me about it?
Yes, Home Sweet Home is a special offering that Security National has. When your borrowers close with Enact, they will have additional coverage options for their home. There's 3 options, and you get to select between an appliance home warranty. That gives you coverage for 1 year and reimbursement up to $500 on each appliance. The second one is a homeowner's insurance deductible reimbursement. That gives them coverage for 5 years, and if they have to make a claim on their homeowner's insurance, they'll be reimbursed up to $1,000. And then the last one is identity theft reimbursement and restoration consulting services. That gives them coverage for 5 years and reimbursement up to $1 million.
And this is included in their mortgage insurance that they're already paying?
Yes.
These are just perks for using Enact on their mortgage?
Yes, and these are at no cost to you or your borrowers.
That's awesome. So it's already included in the price that they're paying for the mortgage insurance.
That's right.
Yeah, we need to make sure that people know about those extra perks because
100%.
you're already tight when you're buying a house, and so having those unexpected expenses for insurance is really something to come in handy. Mortgage insurance insures the lender, but this home sweet home that you offer is perks in helping them with their cost if they have an event on their homeowner's insurance, right?
Correct.
Okay.
So when they buy a home, if they have less than 20% down, we just talked about private mortgage insurance, which protects the lender. They also have to have homeowners insurance that protects them and their home. So Home Sweet Home is a value add to protect them on their homeowners insurance, not on their PMI.
Okay, that makes sense. So it's a perk with the PMI, but it helps on the other type of insurance that they have on their house.
Correct.
Wonderful.